Hello and welcome to the Howard Wright Know Your Money podcast. I'm Ashley Smith.
And I'm Tom Richards.
On the Know Your Money podcast, we talk everything finance, from financial planning tips to how what's going on in the world around you affects the money in your wallet and, most importantly, your financial future.
If this podcast helps you, please like and subscribe so that we can help as many people as possible moving forwards. In today's episode, we're going to be discussing the 6 most common investment mistakes to avoid. Most of these are linked to behavioural biases we spoke about previously on the podcast. Investing is a great way to increase your wealth and work towards your desired lifestyle and future financial objectives. But it's by no means a smooth process, and many investors can make mistakes that can ultimately be very costly. So, Ash, over to you. What should our listeners avoid doing in order to make the most of their investments and stay on course to achieve their goals?
Thank you very much, Tom. So, as a chartered financial advisor, the first mistake that I see time and time again when helping new clients, especially those that have not had advice in the past, is to avoid putting all of your eggs in one basket. If you limit your investment to one market or one industry, you could become particularly vulnerable if it experiences any shocks or sudden volatility. I'll use an example here. So Tesla shares back in November 2021 peaked at $407 a share. By January 2023, they were back at $109 a share. That's a 73% fall. If that was the only asset that you held in your portfolio, that is a huge reduction. If that was just one small part of a very well diversified portfolio, it would have had a very limited impact on you. Second, and with that in mind, not only is it a good idea to diversify across a variety of different assets or markets so that you're exposed to less risk and better able to withstand any economical market difficulties. Second mistake is don't be guided by your feelings. Emotions can run high, especially if you see a big dip like that in the markets. Don't panic, don't pull out, stick with your long-term plan. The market historically will go up, they will go down, and again historically they've always recovered from those biggest of shocks. So if the value of investments plummet, don't be guided by those emotions that say sell, panic, run away. Sit tight, stay calm, stick to the long-term plan, and make sure any decisions you do make are based on the hard data and not just sentiment. The third most common mistake to avoid is trying to time the market. Now, we did again a podcast on this, a whole podcast in its entirety on this, but in short, market fluctuations are a constant companion for all investors. It can be very hard to anticipate which way it will move, whether it will go up, whether it will go down, what the news flow is likely to be. So that big mistake of trying to time the market could see you missing out on the big peaks, but also pulling out of the market and not recovering after you've seen that fall is one of the worst things that you can possibly do. Again, similar to the last point, you should be sticking to your long-term investment strategy and goals rather than trying to act impulsively and trying to time when things are going to move up and move down. The fourth, and another crucial mistake that we see quite a lot and want to avoid, is working with the wrong investment advisor. Getting the right advice is essential, especially if you want to be a successful investor. So make sure you turn to a professional, make sure that professional is regulated and authorised by the Financial Conduct Authority, and make sure they're acting in your best interests as well. And a big point here I would say is make sure that advisor is the right person for you. Just because they're qualified, just because they've worked well with others in the past, doesn't always mean that they're the right fit for you, the right personality, the right strategy for you. The fifth most common mistake that we see, and I've stressed this through previous blogs and podcasts, is that you need to adopt a long-term strategy to investing, and you need to give your investments time to grow. Don't tear yourself up by checking on the markets hourly, daily, even weekly. If you tried to plot a graph with the biggest indices around the world and looked at simply the daily movements, you end up with a very jagged line with very big peaks, very, very low troughs. If you plot that exact same graph, but you stretch it out to 5, 10, 20, 50 years, that line, that graph becomes a much smoother chart. Yeah. So don't focus in on the very here and now, especially if your strategy is a long-term strategy. The sixth and final mistake to avoid is simply not setting clear goals. So without a clear goal, such as I want to retire at this date with this much money, how can you establish how much you need to be saving? how can you establish what sort of risk you need to be taking? There is no point in taking a really high risk on your investments if actually with the amount that you're investing you could take a small risk and still achieve your objectives. So you need to have that clear goal, that clear objective to work towards.
That's brilliant, Ash. Thank you so much for those 6 points there, and I think our listeners will have a lot to take away from what you've just spoken about. Now, I'm sure there'll be many listeners thinking, how can Howard Wright help me with my investment portfolio? Can you just explain to our listeners how we do that at Howard Wright?
Yeah, so first of all, I hope that I've managed to give you some points to consider, some things to avoid when setting up your investments. The best way, as always, to get in touch with Howard Wright so that we can help you and have a look at your overall financial plan and help you to avoid making these mistakes is to contact myself or any of the chartered financial advisors via the website inquiry form. Or alternatively, you can give us a call on 0345 688 4939. We'll then be able to book a call with you and go through your objectives and see how it is that we can help you. Thank you very much for listening to the Howard Wright Know Your Money podcast. I've been Ashley Smith.
And I've been Tom Richards.
If you're watching this on YouTube, please like and subscribe or share on your socials. And if you're listening to us on Apple Music or Spotify, please drop us a follow and leave us a review.
It really helps so that people find the podcast, enabling them to know their money better and build stronger financial futures. Please also check out the Howard Wright Linktree for loads more tips, tricks, articles, videos and podcasts just like this one. And most importantly, stay tuned for future episodes.
This recording contains information from sources believed to be reliable, but no guarantee, warranty or representation express or implied is given to its accuracy. Howard Wright does not undertake any obligation to update or revise any future statements. Past performance is not a reliable indicator of future results. Investments can go down as well as up, and actual results could differ materially from those anticipated. This recording is for the information purposes only and has no regard to the specific investment objectives or financial situation of any individual. The information contained in this recording is not intended to constitute and should not be construed as investment or financial advice. Appropriate personalised advice should always be taken before entering into any transactions. No responsibility can be accepted for any loss arising from action taken or refrain from being taken based on this publication. Howard Wright is authorised and regulated by the Financial Conduct Authority.